All right, guys, here we are. So tax lien certificate, what is this, okay? A tax lien certificate, for all intents and purposes, is just a first lien or a first position on a property. Basically, the way the superiority of liens works in America is something like this. You've got federal income tax liens that can come superior to everything else. Now, those are very rare. You don't find those a lot. It's going to have to be something related to some IRS problems. But then after that, you've got your state tax liens. Well, in America, the states don't really levy the taxes. The individual counties do. So this is the county tax lien against the property. So in the order of superiority of liens on a property, this is actually number 2, but number 1 doesn't come into play a lot. Now, if number 1 is in play on some of these, then you want to probably stay away from them, all right? So this lien is superior to all mortgages, mechanics liens, any other liens that are on a property. So this is basically a certificate for a lien on a property, all right? And like I said, there's thousands of counties around the nation where you can do this, but we're only going to focus on a few. And really, there's 2 ways that this is done. Some counties can wait until the 3rd year for the tax lien. And what really happens here is this. Every year that you don't pay your taxes, the county has the right to go to auction and sell those taxes off to an investor, all right? Some counties are broke and poor and they need money now. Their police officers need money, the schools need money, the roads need money, and so they sell every single year, all right? So if in year 1 you haven't paid your taxes, the county goes down to the auction block and they auction off your taxes to a bidder, all right? That bidder pays those taxes for you, and then he gets some type of return for paying those taxes. That return can be anywhere from 7 to 36%. I've seen some courses that say 16 to 36, but I don't know where they're getting 16 to 36 because I've seen them as low as 7%. And these are possible returns. This isn't exactly the way the returns turn out, and we're going to talk about that a little bit later. So basically, again, you're buying a first position, a tax lien against a property for a possible rate of return, all right? Now, the only 2 things that can happen in this scenario are the person can come 6 months, a year, a day, whatever it is later, and come and pay those taxes. If they pay those taxes off, you then get all your principal that you have invested into the tax lien, plus whatever that set interest rate is. Okay, so if you have $100 into it and the interest rate's 10, you get 110 back when the person pays the taxes. Now, the other thing that can happen is the property doesn't, no one comes and redeems the taxes, I'm sorry, and so the next year another tax sale happens and they sell year 2, okay? After year 2 is sold, maybe you buy that year 2 on that property, or maybe somebody else does. Then if no one comes back again and redeems those taxes, then year 3 is sold. Now, in America, after your 3rd year of tax delinquency, you actually go through a foreclosure process, and sometimes it's a quiet title process depending on what county you're in. And what happens at that point is the actual ownership of the property is then transferred to whoever owns those tax lien certificates, okay? So you either get paid off or you actually get the property. Or maybe there's a 3rd scenario, we go into a Great Depression and government fails, you get nothing. But those are one of 3 scenarios that can happen. So that's kind of an overview and a definition of what a tax lien is. You're going down and you're buying taxes against a property that someone has not paid, property taxes from the county. You buy those as an investor and you get a set rate of return. You either get that money back when they pay the taxes off, or when the property forecloses, you get ownership to that property.